Welcome to the 3 Edge Week in Review for the week of March 13th. I'm Fritz Folts, the Chief Investment Strategist here at 3 Edge, and joining me here once again today is Steve Cucchiaro, CEO and Chief Investment Officer here at 3 Edge Asset Management. Today, Steve and I will be discussing the recent collapse of Silicon Valley Bank, the current uncertainty in the banking sector around institutions such as First Republic, Credit Suisse, and others, and the implication that these developments may have on the future direction of monetary policy and the global capital markets. Before we get into that, let's just take a quick look at this week's activity in the market. And in the end, it proved to be a slightly positive week for equities, thanks in large part to the rapid reaction from the Fed, the Treasury, and the FDIC in response to the collapse of Silicon Valley Bank. By Thursday, the S&P had once again broken above its 200-day moving average. And by the end of the week, yields were basically back to where they were started at the outset of the Silicon Valley Bank collapse. Meanwhile, the U.S. Treasury yield curve remains inverted with higher short-term yields higher than long-term yields. And finally, the price of gold has rallied hard since the beginning of March. And lastly, somewhat lost amidst the angst around the banking sector, was news this week that the Consumer Price Index, the CPI, rose in February by the most in 5 months. So, Steve, you and I have mentioned in the past how oftentimes the Fed tightens monetary policy, increases rates to combat inflation, and they do this until something breaks. And clearly, a week ago Friday, something broke with the collapse of the Silicon Valley Bank. And as I mentioned in my open there, that the government did step in really quickly and came to the rescue of the depositors, anyway, both the uninsured and the insured depositors. But it's clearly created a lot of uncertainty in the market with investors. So my first question is, what do you think the implications are of what's happened at Silicon Valley Bank? And maybe I might ask, is this, the first significant effect of the just very aggressive monetary tightening by the Fed? Where do we go from here?
Well, Fritz, I think it's fair to say that the issue with Silicon Valley Bank does qualify as something breaking. And throughout history, we've seen a series of Fed rate hikes. And each time, of course, what they want to break is inflation. That's their goal. Right. But every time they tighten monetary policy and increase pressure on the markets, whatever hidden problems there might have been begin to surface. And they could come from places that you might not expect. For instance, in the 1980s, as the Fed went into a rate hike cycle, it was Latin American debt that blew up. In the 1990s, we had the problem with the Asian currency crisis and the Russian debt default. In the early 2000s, we had the tech stock bubble bursting. And later that decade, we had the housing and mortgage market bubble bursting. And so increasing this pressure will uncover what was hiding as a problem and bring it to the surface. Now, some people have said, don't be too concerned. Silicon Valley Bank is such a unique situation that has little to do with the rest of the banking system. But the biggest mistake that they made there is not unique to Silicon Valley Bank. The biggest mistake that they made was they took their deposits from all their depositors. They took all that money and they invested it unwisely by putting it all, or the vast majority, into long-term debt. And even though that debt consists primarily of treasuries, which are considered very safe securities, if you buy a long-term bond, no matter how safe the underlying credit is, if interest rates go up sharply, you lock in those low rates. No one's willing to buy those bonds at the price you paid when rates were very low. Now rates are a lot higher. People are willing to pay much less for those bonds. So you have an unrealized loss on your books. And it turns out that the regulators don't punish you for that as long as you never sell those bonds. They don't force you to mark to market. Problem is, if you're forced to sell, then of course you have this big loss. Well, Silicon Valley Bank is not the only bank that made this unwise decision to take their depositors' money and either buy long-term bonds or lend it to long-duration loans when interest rates were near all-time historic record lows. Many other banks did that. Many insurance companies have done that. Pension funds have done it. And one of the most egregious organizations are central banks. Japan, European Central Bank, the Fed, they all bought massive quantities of bonds when interest rates were at all-time historic lows, carrying those unrealized losses on the books. And of course, eventually the taxpayers will have to pay. Now, you mentioned, Fritz, that with Silicon Valley Bank, that the Fed came in to try to rescue the situation. And while only the insured depositors, meaning depositors with less than $250,000 were covered, they went above and beyond the call of duty, and they helped protect the uninsured depositors. And 97% of the deposits at Silicon Valley Bank were uninsured, and they came and saved the day. But what not a lot of people might have picked up on is later in the week, Janet Yellen, the head of the Treasury, said, we're not necessarily going to protect the uninsured depositors going forward. So people need to be cautious about that. I'd also say that in terms of an implication on the market, now that the cat is out of the bag, so to speak, and people are much more aware that many banks have this problem of holding unrealized losses on their books, banks are going to try to improve the quality of their balance sheets, which means they're going to be most likely tightening their lending standards. And this is usually not good for economic growth and often can be a precursor to a recession.
Excellent. So another area that this whole crisis might touch on with the uncertainty in the banking sector, as you just mentioned, is how will it or how might it affect the future direction of monetary policy? Could the uncertainty in the banking sector mean that the Fed is concerned enough that they will pause, even though they think they have to do more in order to get ahead of inflation? How might that play out?
Well, Fritz, many months ago, you put out in one of our videos that the Federal Reserve Board, the Fed, is between a rock and a hard place. And that was very prescient because right now, the Fed is absolutely between that rock and a hard place. If they do hike rates more, and we're going to find out next week, Wednesday at 2 p.m. Eastern time, if they continue to hike rates, some are going to complain that, what are they doing? They're just going to cause even more financial instability and make it even more difficult to control the banking system problem. But if they don't hike rates, while inflation is still way above target, is still raging, then they're going to be highly criticized for not finishing the job and bringing inflation under control. Now, just earlier this week, the ECB, the European Central Bank, had the same dilemma. Right. There are banks in Europe now in trouble, like Credit Suisse. They went ahead and hiked rates 0.5% or 50 basis points because they said, look, inflation's still a big problem. So my guess is that the Fed has some cover here to at least hike rates 25%. And I think if they don't, investors might fear that, well, what do they know that we don't know? Maybe the banking system really is in worse trouble than they're letting on. Or if they're abandoning an inflation fight so quickly, then inflation's going to be here for longer, just like the 1970s. So they're between a rock and a hard place.
Absolutely. Sounds like that. So as always, my final question is as follows, and that is based on what we've discussed here today about Silicon Valley Bank, the collapse of the bank, and the potential, effect and heightened uncertainty in the banking sector, and what effect that could have on the markets going forward. How should investors be thinking about their portfolios at this point?
So what I've been noticing, what I've been reading, what I've been hearing anecdotes about is that there are many investors who are afraid, but they're taking action in a way that we would not recommend. There are a lot of investors that are being sold CDs, certificates of deposit, and annuities, as though those would be the safest places to go. And that's exactly what we would not recommend at this time. CDs are issued by banks. And if you buy a CD that a bank issues and that bank goes under, for anything over $250,000 that you have in that CD, you could be vulnerable and lose that money. Also, banks typically pay depositors quite a bit less than what they can make in the money market. So why give banks this extra cushion? Chances are, if you lock in a CD rate, it might seem great now, but if interest rates keep going up, it's going to seem like you locked in a too low of a rate, and now you're stuck, and often there's a penalty to get out of the CD before it matures. So that's not an area that I would go into, especially when there are so many safer alternatives that actually pay more interest. Like what we use at 3Edge, we would buy an exchange traded fund full of very short duration treasuries that are much safer, paying higher interest rates than a CD would. Then when it comes to annuities, what I'm about to say about annuities doesn't apply to all annuities. They're not all the same, but there are very many that are issued by insurance companies. These insurance companies have made the same unwise decision, many of them, putting their premiums, insurance premiums, into long-term bonds at exactly the worst time. And now they have lots of losses on their books. Insurance companies fail just like banks fail. If you own an annuity by an insurance company and that insurance company goes under, you lose your money. Also, when you read a prospectus of an annuity, often it's more than 100 pages of fine print. You find that there are all kinds of fees. Again, not all annuities are this, but many. Some of them take up to 10% of your money off the top to pay sales commission to the person who sold you the annuity. Many of them, way down in the back pages, you'll find all these hidden annual fees. And then if you want to get out of annuity, there are often these big surrender charges. So annuities are not necessarily the best way to preserve your wealth over and above inflation. Often they give you a rate of return below the rate of inflation over time. So what we would recommend, unless you needed your savings to spend, you needed to dip in your savings and spend all your savings the next few months, as long as you're more of a longer term investor than that, we would highly recommend a much more diversified portfolio that has a much better chance of preserving your wealth over and above inflation, which is really what your goals should be over time. And one way to do that is to make sure that that portfolio is sufficiently diversified to cover a wide variety of conditions. So right now, we have such a portfolio that's targeted exactly to do that. It's called the 3Edge Conservative Portfolio. And it's got lots of investments in short-term treasuries, which earn more than CDs generally, earn more than annuities generally, and are much safer. And you don't have that duration risk. If interest rates keep going up, you don't lose principal value. They own TIPS, Treasury Inflation Protected Securities, which lets you lock in a premium over and above inflation. It owns some gold. Now, you mentioned gold earlier. Gold had its best week since last November, and it thrives in conditions where there's chaos. And if you own a CD or an annuity, chances are you don't own any gold in your portfolio. Right. Gold can be an excellent diversifier. It will include a very modest allocation to equities, so modest that it could withstand a lot of bumps in the stock market, but equities that are dividend paying, and that if the rescue effort is so intense and that helps money go back into the stock market, you at least participate a little bit on that. We've taken this conservative portfolio, we adjust it dynamically based on changes in our model over time. We've stress tested it across every single condition that's happened over the last 150 years in the global markets to make sure that we can cover worst case scenarios of all types. And you can see on the chart, even though there's so much attention to preserving capital and managing downside risk, you can see that we greatly outperformed cash, bonds, municipals, CDs. And frankly, many of our most sophisticated clients use this rather than buying CDs or annuities. And we think this makes sense for a lot of investors who want to be risk averse here, but want to be wise about how they allocate their assets.
Very good. No, I think it's really important to let people know about this the strategy that we maintain, particularly because people are frankly very, very nervous. So it's a really good, elegant solution for the kind of environment we're in now. But thank you very much for the insight into what's happening with Silicon Valley Bank and the banks. And maybe in the not too distant future, we'll look back and say, well, this was, an inflection point, if you will, for the markets. Time will tell. One thing I am certain of is that here at 3 Edge, we'll be paying close attention. We'll remain vigilant, seeking to preserve and protect our clients' assets through both up and down markets. Before we sign off, we want to wish our listeners a happy St. Patrick's Day, which is Friday. And although we now have offices in Massachusetts, California, and Florida, I think our company's roots are in the Boston, Massachusetts area, and that's a city that takes St. Patrick's Day rather seriously. So happy St. Patrick's Day to everyone. And on Friday, everyone is Irish, I think. So that will do it for Steve and me for this week. As a reminder, all our videos always available on our 3 Edge YouTube channel. In addition, all our commentaries and videos are always on our website, and that's 3edgeam.com. So until next time, on behalf of Steve and everyone here at 3 Edge, thanks for listening.